Okay. Hej og velkommen til Lannebo Live. Jeg hedder Carsten, og jeg kommer at prate om Europas småbolag og vores new green transition. Som I kanskje kan høre, så kommer jeg fra Danmark. Jeg just flew in from Copenhagen, og jeg kommer at prate på engelsk, so we will not have any problems understanding each other. So I'm very excited here to be here today. So this is the two funds I really care a lot about, the green transition and the European small cap. I've been working in Lannebo now for 7 years, but working in the industry for more than 17 years. I've also been working as an analyst now for approximately 17 years, so I have a lot of experience. But what I would like to go through with you today is a little bit about the team, because what you will notice is that we have a pretty big team in Copenhagen. Then I would like to go through the European Small Cap Fund, and we'll come into why it's attractive. We'll go through a few cases and how we manage some risk and how we engage with companies and so forth. And then a little bit in the end about our new fund, the Green Transition Fund. It's two completely different funds, but they are based on, you can say, the same credentials, meaning quality and the same investment process. And they are both very, very attractive funds in my point of view. But a little bit about the team. You can see here we have 4 people in Denmark. It's me, Carsten, and we have Ulrik, Philip, and Emil. You probably already noticed now that there's a big difference in terms of ages, and that's a very good strength in our team, because then we look at companies and investment cases quite differently, and that creates a lot of good discussion within the team. But we also get a lot of help from our colleagues up here in Lannebo in Kungsgatan 5, where our headquarters is located. And here you will see that we got a lot of help from our other portfolio managers, but also Maria, who is heading the ESG team, and also for our risk manager, Fredrik. So it's really joint forces here. So even though that Lannebo is quite small compared to our competitors, we have a lot of strength and a lot of experience when it comes to managing our funds. Now let's go through the European Small Cap Fund. Let's see here. Let's start with a slide which can be a little bit complicated, I know. But what I'm trying to show you here is that the performance of European small cap versus European large cap. And when I talk about European small cap, it's already now very important to define what is European small cap. European small cap is companies with a market cap below 5 billion euro. So it's actually in a Swedish and a Danish context, it's rather big companies, but in a European context, it's quite small companies. But what you see on the slide here is that European small cap has since 2001 been able to outperform the market by more than 130%. So it is quite attractive to be investing in European small cap. You will probably also notice here that sometimes European small cap is underperforming. And now we have had a period of actually 19 months where European small cap have been underperforming for some pretty good reasons. And I can, without dwelling too much on the factors behind it, but the most important factor is that there has been some risk off in the market because of high interest rate and high inflation. But that has lasted now for 19 months. And we haven't seen that since the financial crisis back in 2008, where European small cap, also because of risk off in the market, was underperforming by more than 20% for a period of 21 months. No doubt that we believe that European small cap will continue in the long run to outperform, but nobody knows when the inflection point will happen. But we have a pretty good feeling that that when you see the inflection point and when small cap begin to outperform large cap again, it will have a very, very strong run. That's at least what we've seen in the past. Okay, so as I mentioned before, we have actually 8,000 companies in Europe we can invest in. 8,000 companies with a market cap below 5 billion euro. So even though that we have a lot of experience in the team, and we are working hard to find the best companies in the portfolio. We have to, you can say, be quite structured in the way that we are working. We have a quant screening model where we are analyzing all the companies in terms of profitability, organic growth, return on equity, return on capital employed. And we are ranking all these companies in order to find what we defined as quality, so we can spend our time most efficiently. But then we are also keeping our eyes and ears open always. We'll listen to what we hear from other companies. We'll listen to what friends, family, and what goes on in the daily life in order to understand what's going on in the environment. Because here we also get a lot of very valuable information when we invest in companies. I'll come back to that a little bit later. Actually, I would like to already now show you one of our newly investment cases. And that's a quite funny story because that's Intercos. Intercos is a business-to-business producer within cosmetic. You probably never heard about it. They are located just outside Milan. I met them with my colleague Philip only 4 weeks ago, and I had a question the other day. How did you find Intercos? And it's actually thanks to Philip's girlfriend that we found it, because Philip's girlfriend is very, you would say, she's looking at this Kardashian series, which you see on television, and she have her own series when it comes to cosmetic and skincare. And he was, you can say, digging into who's actually producing these products, and it actually turned out that it was Intercos. We looked into the financials and looked and saw that this was actually a very high quality when it comes to margins, returns, organic growth. And when we were digging more into the industry, we noticed that the beauty sector is quite resilient and has a very good market growth of around 7% per year. We also noticed that the big companies, including L'Oreal, Estée Lauder, and so forth, they are, you can say, outsourcing more and more of their production to Intercos, but also other producers. And that's a very big benefit for Intercos, because Intercos produce their own cosmetics. So it's not on behalf of, you could say, L'Oreal and Estée Lauder. But they also produce cosmetics for the celebrities. And here you have the biggest celebrities in the world. They have their own brands being produced at Intercos. When we met the company, there were no doubt in our mind that this would be a very good growth story. The management is extremely committed to create growth globally, and also they are spending a lot of money when it comes to R&D, and that will be, you can say, secure the future growth in the next couple of decades, in our belief. It's worthwhile to mention that Intercos generate 80% of their sales from products they have produced in-house. So that's quite important. It should also be mentioned that Intercos only a few days ago came up with a profit upgrade, so we were quite pleased to see that this company is on the right path. Another company which have been in the European small cap portfolio for a number of years actually is an insurance company. Unfortunately, I cannot tell you the same exciting story as I did how we find Beasley. So this is more a company where we found it through the quant way. We were looking through all the 8,000 companies in terms of quality, return on equity, balance sheet, growth, and so forth. And we found Beasley a few years ago and noticed that they were very, very strong when it came to cyber insurance. Cyber insurance has become a growing market recently, and we believe that cyber insurance is becoming more and more important going forward, especially now when we have more or less the cyber war between the Western countries and Russia. So that's a very good, you would say, starting point for growth. What we also noticed when we met the management is that they are very good at managing risk, because it's quite easy in the insurance business to be too excited, to take too much risk on board, but then you hurt your combined ratio and you hurt your return on equity. This management is very disciplined and had been it always. So this is a company we will probably have in a portfolio for a number of years going forward. As I mentioned before, or indicated before, before we do any investment whatsoever, we always meet the management. So we engage with management. And I often get the question, why do you engage and how do you engage with companies? To simplify it, we engage with companies in order to understand the company better and to understand the management behavior better. The only way you can do that is by, you can say, meeting the management, and preferably on site. This is how we get the best results out of our meetings. We try and also, there's always something which is not perfect for a company. So we're trying to affect the management. And coming from the Nordics, even though that Lannebo is not well known outside the Nordics, management actually listens to us because they know that in many areas like ESG, we are a little bit ahead of the rest of Europe. So they listen to us, even though that we are probably not the biggest shareholder. So what kind of effect do we want to have on management? That is capital discipline, that's dividend, that's more disclosure when it comes to ESG. And as I mentioned before, they listen to us, and that's quite so nice to see. And that has an effect also on the valuation going forward. For a company which are giving more disclosure, then it's being regarded as a completely new company. So that's extremely nice. But it takes a lot of time, and that's why we only have 40 companies in the portfolio. We are long term, so we cannot. Since we are also traveling a lot, we cannot, you can say, have too many companies in the portfolio. So we are quite focused, but we also hold the management accountable. So we always see what they say, and we also listen to what they say and listen and see afterward is that also actually what they do. So we are very open-minded in our discussion toward management and trying to understand why they're doing stuff, sometimes not completely in line what they have told us. And that creates a very good circle when it comes to engagement for us. We understand the management better, we understand the company better, and we also understand the risk we are taking. Sometimes we, of course, have to sell the company because of some disagreements with the strategy or whatever, or because of valuation. But traditionally, we have the companies for a very long time in the portfolio. Okay. Now I'd like to a little bit discuss how do we see risk, because risk is very, very important. It's not just a matter of stock picking, finding the best companies, especially not in the environment we're living in now when we have much higher interest rate. We are, of course, looking at more the statistical measures like tracking error, Sharpe ratio, standard deviation, and so forth. But we're also trying to look at it in a little bit different way. We are looking at the themes which are dominating the market right now. And we believe that it's a matter of being balanced. Right now, we believe that there are 5 themes dominating the market. That's ESG, it's digitalization, it's interest sensitivity, it's medtech and leisure. And what you will see here in the coming slides, I will not go through all the companies, but what you will see is that we are exposed to all the 5 themes which are highlighted here. ESG, we have Louvre, Dyr. We also have Inwido, by the way, which is a Swedish company in the portfolio, which are the leading company within producing windows for the Nordic and for the Nordic market. Very, very professional management and extremely good business model. When it comes to digitalization, we also, as you can notice here, we have Beasley, which I just mentioned before, but we also have other companies, Crayon in Norway, keywords which are in gaming, within the gaming industry. TKH is a Dutch company, and also other companies which are all, you can say, benefiting from digitalization. Then we have the interest rate. We have Sparbank Nord in Norway. We have Spar Nord in Denmark. We have Barvak, an Austrian bank, but also Aroundtown, which is a property company. All these companies are to some extent or quite largely affected by interest rate, and you have to be have some exposure to interest rate sensitivity. That's no doubt about it. So that's we have here with the following companies. Medtech, we have Uniphar Lannebos, which is a French company doing elderly care in the French market, very successful compared to the competition, and very good organic growth. We have Nexus. Nexus is a German company helping hospitals being more, you can say, digital, and also being able to be more efficient in the market. And then we have leisure, which is a new, or a relatively new theme since we opened up after the COVID. Do & Co, Brambo, Coach, and Strix, and AEK, a Swedish company, is also benefiting from leisure, more leisure among consumers. So all these companies are benefiting from this new leisure trend among consumers. So what you'll see here is. Here's also a lot of data. This is the strategy which I've been responsible since 2006, and we, as a team, have been able to outperform the market by around 3% on an annual basis. We had a pretty good, on a relative basis, we had a pretty good year, last year, and also the year before. This year, we are a little bit below benchmark. We are 3.5% below benchmark. But I'm confident that with the companies we are investing in and the way that we are long-term and also engage with the companies, we will be able, and also in the long run, to make a similar excess return going forward. So that's now we are finishing the European small cap. Now I'd like to go into the new fund, which we launched back in September last year. So that's a completely new fund. And here it's here all the companies are are benefiting from the green transition which takes place in Europe. I think we can all agree on the fact that Europe is leading the way when it comes to the green transition. And we can see consumers, we can see politicians really backing up this new trend. So there's no doubt that this kind of market in terms of green transition will be a growing market for many decades to go. But we're also aware that there was a lot of risk attached to this, because new companies will arrive with new technologies, which will probably, some of them will fail and some of them will be successful. We are quite, in our approach, we are quite, I would say, conservative and prudent in our way of, you would say, investing. We always want the companies to be profitable. We want them to have a track record, being able to you can say, have a right organization and not being only based on a good idea. And then we help actually help the company in order to disclose better, to get more exposed when it comes to other investors, that unfold the whole investment case for us. So we believe that we are quite different from other Article 9 funds, as we call it, because we invest in small and mid-cap in this fund. A typical Article 9 fund, they more or less invest in all the same companies. Super large caps, mega cap companies globally, they invest in completely the same. We are quite different. We're trying to find the hidden gems, but it requires a lot of work, because we have to do a lot of documentation with the help from the companies in order to find which companies are really green. And here, greenwashing stands out to be very important, because we want to avoid any companies which are, you can say, claiming they are green but not. That's what we call greenwashing. So we have a lot of, you could say, in-depth analysis of the company. We're meeting management and trying as much as we can to really understand the green activities they have. And as a minimum, they should have 25% green activities. So these companies are really, really green. On an aggregated level, you can say that the portfolio have around 60% green activities. And we're also always trying to push them and engage with them in order for them to increase their green activities, but also for them to lower their CO2 emission. And here we are pushing them to sign the Science-Based Target Initiative so they can get aligned with the Paris Agreement target of 1.5 degrees Celsius. So that's very important. It takes a lot of time, but I think we have come a good, very long way, finding the right companies and also doing the right in-depth analysis. Here, there's a lot of information on this slide, but you'll find a few of our most important holdings in the fund. Maybe I can just mention Renewi, which have a weight of 4.7%. It has green revenue of nearly 90% and have committed to net zero target. So that's quite positive. It's an engineering service company focusing on infrastructure, and they are very committed to green activities. It's listed in UK. Then we have Salchef, which is an industrial company specializing in rail infrastructure. Also a very high quality company, very good backlog and very strong position in the European market. So that's a lot of companies which we will probably again hold for many years to come, because they will continue to grow, have very good returns, and the green revenue will continue to increase. So we believe that this is a unique portfolio, and it's very different from other portfolios you see focusing on the same subject, green transition. Now I think I will go to questions. So if you have any questions whatsoever, please write it, and I will try to answer them as good as I can. I can see I have one question here. Are there what's your favorite Swedish companies that you have invested in the fund? Here I would like to, you have, for example, Inwido. As I mentioned previously, Inwido we have had in the fund for a number of years now. Inwido is, as I mentioned, producing windows. They have a leading position in the Nordic market. They're benefiting from the green transition. No doubt that high insulation when it comes to windows is very important, saving on the energy. So they are having some very strong structural growth. And management have been very good at not only growing organically, but also making a lot of bolt-on acquisition. And therefore they've been able to have an extremely strong position in the Nordic market. Another company which we have in Sweden, and we also had that for a number of years, is AAK, located in the southern parts of Sweden. They are producing vegetable oils and really benefiting from the more healthy trend among consumers in the way that they are living and eating. So they also have very strong structural growth in the market they are operating in, and they're actually been able to continuously how should I put it, putting a lot of focus on R&D and being able to launch specialized vegetable oils, meaning that they are being able to get a very high premium for their products and being able to have a very close relationship to their customers. They are actually the customers are actually quite dependent on AAK. That's very nice to see, and we also believe that AAK will be in the portfolio for many years to come. Then there's, are there any European markets that you avoid to invest in? No, we're trying to be pan-European. We invest in more or less all European countries. We don't invest currently in Greece. We don't have any investments in Spain and Portugal, but that's purely from a bottom-up perspective. It's not that we dislike Spain or Portugal in any way. We just haven't found any companies currently which we think are living up to the criteria which we like to have. Then there is another question. As a Swede, investing in a European equity means an exposure to the euro. Is the euro-SEK exchange rate something you think about? No, we don't do any hedging whatsoever. In our point of view, it does make sense because many of the companies, they are global companies, and many of the companies are hedging their own activities themselves. So it would not make sense for us to hedge on top of that. That could create even further risk for you as an investor. And then another question, how has the reporting season been so far? Here we should maybe mention that Swedish companies are a little bit ahead when it comes to reporting first quarter. But what we can see is that reports in Europe, in the European small and mid cap, have been actually being pretty good. That's also what we've seen in Sweden. We haven't seen any big effect when it came to, you can say, increased inflation, increased interest rate. And here I think it's important to stress that many companies have been gone through a very turmoil time. They have gone through COVID, supply chain restriction, and so forth. And that has been, you can say, really made them agile and been much more flexible. So I think that even though that we could have, you can say, some downturn in the economy, most companies are really ready for it and ready to react quite quickly. So that's quite positive. How do you view ESG concept and arms manufacturers such as Saab and more? Many funds have started to turn in this regard. We do not have any defense in the in the portfolio. We are trying to be true ESG fund, and therefore we are avoiding companies which are, you can say, within defense. That's quite clear. Giving so that's you can say, even though that you can argue that that is something which is good to invest in. Now when we have the war with the Ukraine, we believe that in longer term it will create other problems because we are only investing in true ESG companies. Okay, I think that's. Let me see if there. It seems like there's no more question, and I. Once again, thank you very much for joining me in this live presentation, and I hope you all will have a nice day. Thank you very much.